Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Let's start with the butterfly. Let's say that you believe the currency will stay in a range, and you don't expect a lot of movement from it, but you don't like the idea of selling a naked option. That just scares you, or it's not your thing. A butterfly combines a credit spread and a debit spread with the same short strike price, and there's only one margin requirement. Now let's go ahead and take a look at this. It makes a little bit more sense when you actually see it on the screen. So let's go ahead and create a butterfly. We're back at the OptionsXpress site. Let's go ahead and bring this up. And these are live quotes, by the way, folks. I like showing actual real examples as we do them. So let's go ahead and look at Canadian dollar again. Stick with the theme. And we'll start, and I'll explain all this in a moment. $123.50, $120.50, and then we're going to go with $126.50. There's another way with which you can just click all of this on one screen, but with that, we're just going to do it this way for today. Okay, with this, what we are doing, the $123.50, that's where we think this option is going to expire. We believe it's going to be at expiration at $123.50. You can see in there that that's where our maximum profit is. Now, real quick, I want to show you what attracts a lot of people to the butterfly. The most you can possibly lose on this trade is $900. Mathematically, it's impossible to lose any more than that, not including commissions. Now, keep in mind, this is a pretty high dollar butterfly. This is actually a 40-lot butterfly. You're trading with some somewhat serious money if you're doing this. $900 can then become $2,100. That's not too bad of a risk reward if you're absolutely right. So with that, we believe that the option's going to stay, or the underlying is going to be at $123.50 at expiration. And if that's the case, we're going to make some nice money on this. Now, here's the problem with the butterfly. Notice the range of movement, or the range of error that we have in here. If it's not right at $123.50, we're not making $2,100. And with that, you can see that the range of profit, this solid line, is the profit line that exists within this butterfly. So to break even, CDD has to be between $121.40 and $125.60 at expiration. Anything in between there, with it peaking out at $123.50, gives us an actual profit on the trade. If it's beyond there, you lose money. That's the bottom line. Now, the benefit of a butterfly, it's dirt cheap. The disadvantage is that the range of error is not too much. You better be right on if you're going to do it. Now, to give you an idea, we had a request for the inverted butterfly. I'll show that real quickly. We have a button on our site. You just click flip, and now we click calculate. And this will kind of go back to if you're expecting a lot of movement, then right in here, if the butterfly is the most you can lose, in this case is a little over $2,600, and the most you can make is $380. So with that, you're risking a lot more money to do this, but all that needs to happen is that the price is beyond these strike prices. So if the stock goes below the long strikes, you make a pretty decent rate of return on it, over 10%, probably about 15% if I'm doing my math in my head correct. But if it's between, or if it is at that level, you will lose money on the trade. and you'll lose quite a bit of money when you're wrong. So that is the butterfly trade. The other thing that I guess that you could do on a butterfly trade, let's go ahead and flip these back. Let's say that you want to be a little bit bullish. Well, let's go ahead and change these from 123. Let's say we don't think it's going to peak out at 123. We think it's going to peak out at 125. And in fact, let's actually do this one over. Let's just do this one over. I'm going to show you another way with which you can do this. We go through the option chains. And then let's go ahead and enter CDD. And let's say that we believe that at expiration it's going to be in the area of 125. What we're going to do is sell this call. We'll go ahead and buy a 126.50, and we'll buy a 123.50. Scrolling downward, we click on Trade Calculator, and everything will be populated for me. We click Calculate, and now we have a bullish butterfly. So if the stock does go up a little bit, you can see that we're risking 300 for the potential at 1200. That's a butterfly. Okay, and if we have time at the end, we'll show the skip strike butterfly. All right, what if that range is just too tight for you? You're looking at this and you're thinking, you know what, I like the idea of that, but that range is just too tight for me. Well, one thing you can consider as well would be an iron condor. Short strike price isn't the same, but we have two credit spreads. So with that, we're trying to make it between a specific range to do an iron condor. Now let's take a look at an iron condor, and this will actually be, I believe this is the last example that we're showing today. But nonetheless, let's take a look at it, and let's see how this would work. Let's say from our chains that we wanted to do a double credit spread. And let's say that we think that CDD is going to stay between 127 and 121. Oh, and we'll say 120. We're going to sell both of these options. I click once for buy and twice for sell. And let's say that we want to buy two strike prices out as our hedge. I'm sorry, $2 below and above is our hedge. So we're going to buy the 118s and we're going to buy the 129s as our hedge. Scrolling downward, we click Trade Calculator. And we're just going to leave this all as one lots. We click Calculate. Now, the concept's going to be similar to this, but you'll notice within the iron condor that we have a wider margin of error. Instead of having that peak in the middle, we have a wider range. To make maximum profit in this case of $67, it has to be between 120 and 126. So with that, and actually it's 127. So with that, what you would need to do is just put in that four-legged credit spread, and you want those options to expire worthless.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.